Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today we have a guest, many of you may know it, David Ramsden-Wood, or DRW, as we like to, as all of his friends call him. Just a pleasure to have you on. Please give a quick introduction, and then we can kind of jump in and follow the hydrocarbon around the world.
I love it. No, Mark, great to be here. You and I obviously met in New York in November when we were both on with Alex Steele. And I think the 3-minute segment that we had was followed by about an hour and a half chat in the lobby. And we've stayed in touch ever since. So, been thrilled to see what you've been doing. And I think really accurately been calling a lot of the issues that we see now. And so I get a lot of value out of the conversations, and I'm glad to be here. So thanks for inviting me.
No, absolutely. I mean, you've been kind enough to have me on twice, and we've had some great conversations. So I think it's good to follow up. And one of the things that we were talking about off screen that was in something of interest as we go forward, it was really that 38 million barrels a day of oil demand destruction that we've seen. And I think it's a good place to kick off in terms of, what do you see now? Like, what are you thinking now as we start to see some rolling reopenings? Some of these countries start to come back.
Well, it's really interesting because I think that predicting the down was so much easier than it is the up. And I think that the same thing goes for the whole economy. Shutting the economy down was easy, but restarting the economy is very hard because there's this how much people want to go back to work. And I know that the China data shows that during the week, maybe people are driving as much, but during weekends, they're not. And so, where are we now? I mean, my gut tells me 15% down-ish. So would you say 15 million barrels a day of demand destruction as of right now as the economy kind of reopens? And then the big open question is, do people start flying again? And do people start going back to work every day? And I'm curious your thoughts as well.
It's interesting because I kind of use a range now just because it's going to vary on a week-to-week basis. So I'm something similar. I'm saying between 15 and 20 million barrels a day of lost demand. And the way I'm looking at that is, jet fuel is just not the same. People are not flying the same way. So, if you think of the world as thinking 8 million barrels a day goes into jet fuel, is it 2? I mean, at this point, you still have to fly. You still have some things that are moving, but no one's moving the way they used to. And now you have the work from home, and you have the work from home orders that have kind of ripped through across some big driving regions, specifically, Pad 5 or the West Coast, throughout the Gulf of Mexico, and then obviously in the Northeast where you have the most amount of transit, and then people have pushed back and said, well, if they're not taking a train, they're driving. It's like, well, how about they're not doing both? Like, they're just staying home.
Well, and I think that's the thing, right? And it's one of the personal experiences when there's a disconnect, right? So the S&P is above 3,000, and yet you hear about people being laid off and unemployment rate being around 20%. I think about my life pre-corona. And so really from October until March when the lockdown happened, I was on at least 4 flights a week, just around the country and in 2 cities. And so when I think about the amount I was traveling and the amount I was driving versus now, I haven't been on a plane since March. And this has to be the first time probably in 20 years I haven't flown once a month. And if you extrapolate that, I agree with you. There's so much demand destruction. And then on top of that, and I think that this is what people miss, is in 1985, we did not have the same level of demand destruction. And so that is probably the most similar downturn. But the difference is we probably have 1.5 billion barrels of oil and refined products in storage in some capacity. And so I know we were going to talk about the EIA report, but a lot of people were pointing to that the last 3 weeks saying, well, look, oil is declining, inventories are declining, but production was shut in. And this week, I think for the first time, we saw inventories increase.
Yeah, and it's interesting that just kicking off with the EIA, and you look at the supply data and the demand data, and it's that demand number, the implied demand, it's a calculated figure. So you have to think about, okay, well, how much of it is fungible, how much of it was just assumptions. But then when you take those real life cases from your perspective, like you're not flying as much, you're not driving as much, and when does that go back to normal? And for you, it may be like, look, I'll get back to normal as quickly as possible, but what about the guy on the other side? What about the go-between? And that's where I think, to your point on how how quick we kind of get back up that curve that we really came down is going to be so hard because lives have just changed, and it hasn't gone away. It has, like when we first spoke, the goal was to really not stress the hospital system. And we've achieved that. We're there. Like we're there. The reopening can start. Like I've told you about my mother and her hospital, and they've gone from 19 floors at peak with people in conference rooms to 7. So now you're starting to see but at the same time they're 13,000 surgeries behind. They're going to have to start to run this up to really capture it and to catch up. But it's just going to be such a slow slog because you can't overwhelm the system, but at the same time, you can't stay shut down forever.
Well, and then there's the nuance that I'm seeing. And so we own a place in Arizona that we Airbnb, and the requests coming out of New York and California in the last 3 weeks are inundating. Like the place fills up because everyone wants to leave the states that are locked down to go elsewhere if they have the means, which again comes back to this whole point around if you have the means. Right. And so we started about the EIA and inventories increased this week around 7 million barrels. Do I remember that number right?
Well, if you factor in the SPR, it was just over 10 million.
Okay. And so that plus all the shut-ins and one of the things from this storage that we haven't seen, imports were up 2 million barrels a day week over week, which to me has always been as soon as oil is 35, if a financial player bought oil at 20, at 35, they have a wonderful profit in 3 months. Yeah. And so they start dumping that oil into the market. And so we see imports go up, we see storage go up, and then we see the commensurate move back down in oil prices. And if you couple that with a risk off in the S&P, I mean, oil should not be trading anywhere near, in my opinion, the 33, 34 where it's trading. It should be in the mid 20s still based on the dynamic.
And it's funny that you say that because this is a narrative I've been working on, and let me just bounce it off what you're thinking on this. So I have all this data on floating storage. So if you look at floating storage, and this is my overarching theme, is that Saudi and Russia are going to manage the curve to such a point that they're not going to allow the U.S. E&Ps to hedge at a profit. So they'll let the front month rally. They'll let a little bit of this love come into the front month, but they're going to manage that curve to make sure it's below, let's just call it, is the magic number 45, 50, but it's something in that level where it's like, how do we maximize pain for them, but minimize the economic damage for us? And when I look at these storage figures, it's interesting that you say that because you have the Middle East floating storage coming back down to normal, but it's exploded in Europe, Asia, and the US. So is it this repositioning or this movement to kind of manage that number, but at the same time to keep maximum pressure on US E&Ps?
Well, and to me, as much as anything, it's about like a fight. So I have made the point, and I know that you've seen that this was less about Saudi Arabia punishing the U.S. And I know that the common, in my opinion, urban myth, but right. the common misperception about 2013 and 2014 when OPEC opened the taps was to punish U.S. shale. But the Permian in 2014, especially early 2014, was nothing. Yeah. And yes, we had rollover, but the Bakken had limited inventory, as we know. The Eagle Ford had limited inventory, as we know. Yeah. We weren't as active in Oklahoma, and the Permian was nothing. And so what did happen at the end of 2013 was the Russians invaded the Crimean Peninsula, and I know we're going to talk a lot about geopolitics. Mm-hmm. But if you want to hurt the Russian economy in 2013, when oil is $100 a barrel, you increase production. And so to me, the punishment that was done in 2014 was about Russia at the behest of the US. And that in 2020, this is the first time where Saudi has said, you know what? The US is down. We're really punishing Russia. But if we're going to punch them in the face, let's make sure we win. And we're going to make sure now that we're in the fight, we do everything we can to depress prices so that the US can never come back. And so I don't think it was the intent, but now that we're scrapping, they're not going to take their foot off our throat in the oil market.
And it's interesting that you talk about the geopolitical side of 2014 because You also the worst kept secret was that the U.S. and Iran were going to come to an agreement on the nuclear terms, and you had how many millions of barrels sitting in storage, and Saudi Arabia sitting there saying, well, I can get Russia and I can take away value from Iran so that when they do open the taps and they start selling it to the market, it's not going to be at $85, it's going to be at $45, and then it's going to be at $35, and now it's just a different market. Like now we've seen the US come to about that 13 million, which I think when we last spoke, that was the peak for me. I mean, for last year I was saying in 2019, like, look, I thought exit 20 was going to be below exit 19. Like we saw the top and we just saturated the market. And now we're starting to see this pressure. I mean, when you're looking at this and you talked about guys coming off, one of the numbers that was kind of buried in the EIA was that they have supply down about 1 million barrels, which puts us at about 10.4 million. Based on who you talk to, what you're thinking, like, are there going to be guys at $33 they're going to come back on because shut-ins don't make sense because it's a sunk cost?
I think, and those are all the nuances. And so I love this conversation. I always love chatting with you because so many people want to say in the 2-line, byline, headline, this is the same as 85, look for a V-shaped recovery. Right. But we can talk about what the major differences are. So number one, the Saudis are now taking different action because they understand that when you're an oil nation like Iran and you have potential ability to destabilize the region, $80 oil gives you more currency than does 40. Right. I think the other big difference, and it was around the time we met, was Saudi Aramco was doing an IPO. Mm-hmm. And it was not well received in the U.S. market, so they floated very few shares. But what came out of that was, in their public disclosures, they have a 53-year reserve life index at 10 million barrels a day. And if they were Exxon, they would have a 17-year reserve life index. And when we talked in November, it's like, well, the Saudis can't accelerate because if they go from 10 to 30, then oil would go to $5 a barrel and nobody wins. But by displacing U.S. barrels, by hurting Russia, by hurting Iran, by hurting Nigeria, by hurting Mexico, they can now ratchet up their capital investment as the low-cost barrel in the world, because I think that we all now see demand might peak in the world for oil. And so this isn't a legacy 53-year asset. The Saudis have to get that oil out of the ground much faster than they did 2 years or 4 years ago. And so I can see a situation where the Saudis ramp up production to 15, 20 million barrels a day and backfill all of the decline in the world and become the dominant oil player and do away with all of this support of other economies. I'm curious your take on that.
Yeah, it's interesting because when I look at Iran and I look at everything that's happened, people have made a big deal out of Iran sending gasoline to Venezuela. People made a big deal about the what are they called? The Patriot cruise missiles coming out of Saudi Arabia, saying, "Well, we're not going to protect the asset." It's like, or do we know that Iran is in such dire straits that they're not the threat they were even 6 months ago? To your point on currency, in terms of, we have been hitting them with low oil prices. Well, not so much just us, but the world has been hitting them with low oil prices since 2014. They've been under sanctions on and off for the last, a decade now. You're looking at a country that is just struggling, and now they're overextended in Syria, in Yemen, in Lebanon, and they just don't have the capacity. Now they've lost all of their local support that was even somewhat remaining. The U.S. took out some of their key components in terms of military intelligence and structure. And now it's just, I really think that regime change is closer rather than further away. And it's interesting that you say that, because I add the little caveat of, well, right now you have a lot of oil behind closed doors. You have Libya, you have Venezuela, you have Iran, and Libya is being paid to not produce. Venezuela is just Venezuela, and we all know what's happening there. But you have Iran. Like, Iran is sitting on a slug of oil that realistically can come back at a pretty quick clip. Not to say that you wouldn't get growth, but when we look at this overall, like, how do you think Saudi Arabia is looking at this saying, look, I want to take demand, I want to take supply higher, but I have to compete with what happens if Iran does see some sort of regime change and becomes friends with the world again?
Well, I mean, and those are the geopolitical, and I think again, it's sort of the microcosm of the COVID response and what you said. We went from a thing that was flattening the curve to now where I think the new phrase is like stop the spread,
Right.
which is a very different thing. And so when you take the complications of every issue, there's so many nuances to if Iran has regime change, is it regime change to the positive of the rest of the world?
Right.
Or is it regime change driven by the fact that 80 plus million people are starving and of their 5 million barrels a day they could produce, they're only allowed to produce 2 for their own internal purposes? And do you end up having a swing to right-wing fascism, as has happened in the world many times when economies collapse? And then what destabilizing influence does that have? And so every time you're making a call on oil, you're making a call on a very specific event overlaid with another event. And then the black swan of the COVID has just been, it puts us in a really interesting state go forward. I find it more interesting than sports. I mean, who needs live sports when we can be talking about geopolitics around the world?
Absolutely. And you can create these sensitivity analysis of like, oh, if this, then this, if that changes, then how does that respond? And you start pushing these different strings, and all of a sudden you've built all the way back out, and you're like, wow, like this could go in so many different directions. And it's funny because then you complicate it with the different quality of oil. Like, you go back to 1985 and you think about where we sat. We were sitting in a space where there was no light sweet crude. Like, light sweet crude was this Goldilocks of like, this is what you wanted. Now we have so much of it. Like, we've overproduced based on the unlocking of shale and all these things. And now you have this situation of, who can replace Iran? And it's Russia. Like, the Ural is the closest to the Iranian barrel. So Russia is doing nothing to really stop Israel from decimating them throughout Syria, because Russia's essentially said, look, whatever you do, don't touch our stuff, and we'll let you fly through as much as you want and just destroy whatever you want, as long as we're fine. And when you look at Russia on the longer term, where are you thinking about them? Because we've talked about Saudi, we've talked about Iran, but when you look at Russia, like, they're the big elephant in the room that has been overproducing Saudi Arabia. And a lot of that is, to your point on oil demand peaking, a lot of that is in the growth of LNG, natural gas, as well as condensate. And those are some interesting caveats, because I agree with you, oil demand is going to peak, but NGL and condensate demand is going to see some love, and you're going to get some, demand, so you're going to get some replacement value. But where are you looking at Russia? Like, what is kind of your tell as we go forward to see where they're going to push their crude?
Well, again, I mean, I think that there's been a lot of evidence that this was as much about Russia getting back at the U.S., and we're obviously not in a Cold War like we were, but the Russian action on March 5th to say, hey, every man for themselves, was about hurting U.S. shale. And there's been lots of evidence that since 2016, the Russians have been funding anti-frac in the United States. And as we know, out of the 110 BCF a day of raw gross gas we produce, 67% of that is produced from fracking. And of the horizontal shale wells that are 8.2 million of the roughly 13 at peak, all of that is from fracking. And so Russia has very specifically been targeting the US to reduce our supply of natural gas and oil, because they're the net winner. Yep. And so Russia has won, because I think you and I would both say, until shut-ins stop, you're not going to complete oil wells. Right. And until all the ducts are completed, you're not going to ramp up rigs. And so even though rigs are still, in the 400 range, we're going to see that drop well below 200, because there's so many ducts. But until the U.S. can fully open, which means that the systemic decline of 4 million barrels a day, that doesn't even need to be backfilled by Russia. So to me, Russia is a player insofar as they want to see the demise of the U.S. CMPs, but they don't actually have to do anything anymore to have it happen.
Right. And it's interesting, because when you look at Urals and you look at pricing, everyone... The thing that you can see, everyone can see, is the prices on the board and the official selling prices. But we all know that things can cross outside of it. And you had Russia that was selling Urals when Brent was 54. I mean, they had some Ural barrels getting traded at 26. So they're sitting here saying, like, everyone else is getting a better price than me. Why am I allowing the U.S. to come in and take my market share in Europe when I have to blend this condensate because I'm producing for the power of Siberia? And I want to protect my European asset because it's close, it's by pipe, it's cheaper, so I can compete. So now you have these oil barrels coming back. You know, you've talked about the decline curve. You know, as you defeated Matt in the bet of Frac Spread Count of 50, which he turns around and blames me because he said that I said it was never going to go below 50, which is a lie. I said it wasn't going to go below 40 with 37 as my floor. But when you talked about those ducks, you talked about the rig count. I mean, when do we get new completions? Like, what is your take on these new completions coming through, or is this not till a 2021 event?
I think it's a 2021 event, and I think that they're all wrapped up in a similar thing. Because of the overlay of COVID and the PPP loans and just generally, like, companies, they at the end of the day, they act in their self-interest, and 50% of oil and gas staff are staffed to support capital activity. But it looks truly horrific if a company comes out and says, hey, we've seen the future. We disagree with the president. It's not going to be a V-shaped recovery. And so we're going to lay off people now because one more month of salary doesn't make a difference. And so you're still hearing these energy companies talk about, well, maybe there'll be a Q3, Q4 ramp up. But going back to March, when you and I spoke, and we both said, this is bad news bears. Everything is going to zero. Over the last 2 months, people have kind of said, well, we'll cut another 10, we'll cut another 15. Exxon had cut 10% initially and then cut another 20. So I think that once the economy reopens in July, the full depth of how bad this is will be felt. And that's when the layoffs, both in energy and out of energy, will happen, because it will not look like it's related to COVID. It will be related to business. So I think things get a lot worse, and that we basically see no activity in the US from now until Q1 2021, and that will mostly be ducks. And until the duck count is lower than it's been even going into this, there's no reason to drill. So I think the pain hasn't even begun, and that all of the layoffs that are coming and all of the ramp downs that are coming, we haven't seen the worst of it.
You know, it's interesting that you talk about the view on some of these layoffs, because, you know, some of the things that we've been playing around with is this unemployment becoming a leading indicator on what spending will be? Because everyone talks about, you know, it's a lagging indicator because the event happens, companies react. But as you have these loans, you have these things, and you have these adjustments, like, is there going to be that delayed component to it where it's like, look, I'm going to pay you 70% of your salary, and then eventually I'll pay you 0% and you'll become unemployed. But, you know, I think there was a study done where it was that 40% or so of people that were laid off won't find a job in that industry. And when you look at the industries changing, and you talk about some of the layoffs coming in the E&P world, you know, those are very specific states. You know, so some states are going to get it much worse than others. And, you know, where do they go? Like, when you think about the support that's going to happen, you know, can Texas, can Oklahoma see some love depending on how they frack? Like, you know, and this is the tale of two cities that we've seen with oil and natural gas. You know, we've seen equipment shifting away from oil and focusing more on natural gas. You know, do you think we're going to continue to see that shift, or to your point on the fact that we have so much gas and it's struggling to go into the world on an LNG level, and you're going to get this backstop and things remain slow? I mean, are these E&Ps on the gas side that were going to be really good are going to just kind of shoot themselves in the foot again?
I mean, I certainly think that's a risk, but I overlay that with, okay, so we agree that oil-weighted completions for the rest of the year will be low, and that until all wells are flowing normally, there's no reason to complete new wells. You know, a company might take advantage of a 20% reduction in cost and then frack a well but leave it shut in. But for all intents and purposes, we're not going to see oil activity. So if 4 million barrels a day comes out of the market, which is my number, by January of 2021, that's roughly 16 to 20 BCF of gas that previously we had to push overseas, and now it stays domestic because we don't have enough. So I personally think that, yes, gas players will be winners and that the gas price will float up to the next marginal MCF, which in the Marcellus is kind of 250.
Yep.
So at 250, the Marcellus is blowing and going, and a lot of the rigs that had moved to the Permian and out of the Bakken previously are now going to move out of the Permian to Appalachia, and that there will be benefits for gas players who have assets there, and that the spinoff will be places like Oklahoma that are gassy, that haven't seen activity for the last couple of years, will be able to at 250 or 3 do recompletions or do rework of compressors and midstream systems to bolster value. Now, as a buyer, would I go buy an asset for gas right now? No, because you want me to pay 275 strip and the strip is not there. But do I want to be owning natural gas assets and preparing to invest asset dollars in natural gas assets in the next year? Yeah, absolutely.
And it's interesting that the one, you talk about the associated gas and what's lost, and that 18 is a big number, and it's hard to really wrap your head around how much associated gas really comes out of these wells. So when we're looking at this and you look at, there was, ethane prices went up because you also had ethane. So there's an NGL component. So when you're looking at these components between Appalachia, as you talked about, Pennsylvania, the Northeast, where are you thinking in terms of Appalachia versus Oklahoma? Because Oklahoma, you have a lot of dry gas, you have a lot of spare capacity in terms of pipe, and on a geographic level, you're closer to where you want to be, which is going into some of these industrial levels. But like you said, 250 is an interesting spot for Appalachia. So do you think that there's going to be a combination and kind of both win, or is one going to be better than the other? Or could we just see kind of a new play a little bit, develop in this dry gas region of Oklahoma?
I personally think it's going to be some new plays, because there are a lot of talented people in energy that are oil finders and gas finders, and they've seen natural gas, which has been in a bear market since I'd argue 2006.
Yep.
But like coming out of Aubrey McClendon was probably the most successful natural gas bull of all time, because he took a U.S. shortage in 2001 to such a glut that the gas is still 250 today. So I think that you see winners in Oklahoma, and in part it's because that state and Texas are aggressively opening back up, in part because the population density, but also there is a big divide between Republican and Democrat because of what people believe. There's a civil liberties and personal choice element to Republicans, and there's a social good element to Democrats. And so when I look at Pennsylvania, New York, New Jersey, California, but then I compare that to the views in Oklahoma and Texas, I think Oklahoma and Texas are a winner because those economies will just open faster. So the mobility of the people who've lost jobs or want to get to a place where the economy is open, I think that they start looking for opportunities, and dry gas in Oklahoma and Texas are certainly going to be one.
And when we look at some of the data that we have, and you look at the primary vision frac spreads, we're 10-1 for the most part between Appalachia and Oklahoma. So as you talk about things going that went from the Bakken to the Permian and now to Appalachia, do they say, what, let's not go to Appalachia, let's go to Oklahoma. It's closer, it's easier to get to, and there's opportunity based on a reopening as well as this demand for gas that has to be filled. And we all know dry gas, it comes out relatively easily compared to other things, and at the same time, it's easier to process. The dry, for those that don't know, dry gas just means that you're coming out with over about 93% methane. And then as you talk about wet gas, there's different levels, because wet gas just has more NGLs or natural gas liquids, which is going to be a mixture of ethane, propane, butane, and then isobutane at the top. So there's always a mixture, and the U.S. happens to be very rich in both dry gas and wet gas, but the wet gas is levered towards ethane. And it's interesting as we look at Appalachia, turning back to Appalachia, you also have a lot of capacity that is rich in ethane, and we have a ton of ethane crackers. But at the same time, you have a chemical market that's just horrendous on levels of overcapacity that was in existence since 2018, down to just terrible economic numbers and growth abroad. So it's going to be, I think it's a mixture of like who wins, who loses. You have some of these guys like a Southwestern that very low debt profile up until 2024, But at the same time, they have a lot of exposure to the spot market, and their cost break even is a little bit higher. Is that a beta play? When you're looking at this and how to play this, is this something of, these guys are going to win because of circumstance? Like, how are you looking at this from a personal level or a corporate level? And if you're talking about strategy, like, what are you advising some of these guys to do?
Well, I mean, to me, number one, you have to be in a position to be long gas. I think that's number one. And I think about it from the world is that I think what comes out of this is localization. And so we've been in a phase of globalization where the world has been expanding. We've been offshoring a lot of our pollution. So, Greenpeace and others would give companies a really hard time, and say, well, you've lowered your greenhouse emissions. But that's just because we moved manufacturing to Asia, where 74% of the electricity is generated by coal-fired electricity. Right. And so to me, when you ask, like, how do I advise companies? Well, if we have this thing of localization, where we're going to start bringing manufacturing back because there are some critical supply lines, some critical infrastructure, plus very, very high unemployment. Because, we talk about this, hotels, restaurants, airlines, they all operate on very, very thin margins because the consumers won't pay more. And so if you drop capacity even 10%, that's the difference between a business being like open and zero.
Right.
And so in order to fill those jobs, I do think there will be sweet spots where natural gas as a low carbon emitter relatively, as a consistent fuel relatively, and as an abundant fuel for sure, places that have high amounts of gas and high unemployment will bring manufacturing back from overseas to be able to compete on a cost level. And so those would be winners. So as a company, I would say number one, be long gas. Number two, get your balance sheet in order. And so that the only way to do that is to shed costs by shedding headcount and not doing anything. And number three is, I think it's own the supply chain. And companies have bifurcated by spinning off their midstream assets because they saw relative value, or not owning the end user of the utility and not being able to control the market. I do think guys owning the full value chain of power plants, pipelines, and producing infrastructure is the way to win. And in Oklahoma, you're going to see opportunities to do that for sure. Same with Texas.
And it's interesting because you also had President Trump talking about bringing and paying for, the Taiwan semiconductor and coming back. Because if you think about what was left, the conversion away from China begun, let's just say early, mid to late 2000, early 2010, just because the cost of doing business was going up. You had people wanting more, better living conditions, better wages, just what you would expect in a rising economy. But the last thing to leave are the things that really suck juice from the grid, those semiconductors, anything that has this massive power demand. But at the same time, if you look at the US, we have all of these natural resources, but we have a failing grid. Like, we have a grid that's been ignored for how long? So when you're looking at this going forward, you're going to say, look, Oklahoma has the people, the space, the natural resources, but how do we build the grid? And this is when I have conversations with friends about, well, if you look at the 50s, what did we do in the 50s? We built the highway system. The highway system yielded a huge amount, and it was a huge public works undertaking, which provided jobs and then had a multiplier effect that has, carried us well into 2020. Do we see something like that just on a grid level?
For sure, the grid over time will get upgraded, and it's sort of the argument about houses, which is kind of interesting, is that like houses are sort of a depreciating asset like a car, because at some point you're going to tear it down, and yet the way our economy has worked is the value of the land somehow accelerates faster than the decline of the house, and so but the infrastructure is clearly crumbling. because it was built in the 50s. But if we're bringing back a whole bunch of new, do we really need a grid if you could put the manufacturing right beside the power plant?
Right.
And so if you already have existing pipelines that are underutilized, so you can get the gas to the power plant, and if it's the takeaway capacity, well, then you go build your manufacturing right in the same area, which from a revitalization of towns, which I also think is an important trend that gets overlooked, is people in China and in the United States were leaving rural communities, moving to cities, and becoming more service oriented because we'd offshored all our manufacturing. But now, like, towns exist because we make things. And so do we have the opportunity to revitalize towns in these communities, which also from a virus perspective, you don't have 28,500 people per square mile riding a metal tube in the dark and cold, touching everything. Right. And they have an opportunity in Oklahoma to have acreages and build manufacturing. So yeah, this opens all the trends, which begs all the questions around where we started is, what is long-term global oil demand going to be in a post-COVID world? Because so much could possibly change.
And it's interesting when you think about where this is going and we talk about the microgrid. And this is something that has been considered, been talked about, what is the microgrid? Is it something where we can help diversify away from just, dirty fuel, and we can create something that's more localized? And the big focus that I've seen, based on my experience in the Middle East and working these things in terms of short cycle gas turbines, solar, geothermal, wind, as a basket works. One can't really dominate versus the other. It has to be a basket approach. And when you're thinking about this build out, could you see some more replacement, as we talked about with oil demand, where not only are you getting more natural gas usage, but you're also going to see a bit more solar because we're building these big facilities that are going to be off the ground, so they'll be more efficient. They can be consumed locally and then kind of push whatever you want into remaining into the grid. And you start to almost update, like you said, without this huge outspend, but in a localized level that meets the green agenda, but at the same time still revitalizes these different areas.
Well, and to your grid point, if you had solar panels on everyone's house, clearly they would be using less energy from the grid, which means the grid, like pipelines, would have more capacity to move that elsewhere. And so yeah, I think that all of those things make sense, but at the end of the day, it's about the dollar. The green agenda is neat, but the green agenda was in place because people owned this mechanism to sell and buy carbon credits, which created wealth for the owners of that. And people didn't own oil and gas leases. Therefore, the only way that they could create wealth for themselves was going to be to push a wind and solar agenda because dollars would be spent. And so at the end of the day, if the consumer can get value by putting solar panels on the roof, they'll do it. If a manufacturing can be done in a microgrid way right next to a power plant, and that makes cost of living cheaper and risk of COVID cheaper and all these things, people are going to do it. So I think all that changes, and it comes back to the point I made about Saudi Arabia. Saudi Arabia has seen this and is investing their petrodollars throughout March and April in companies that were non-oil and were beaten down because they're taking oil dollars that may not be there 20 years from now and trying to diversify into other parts of the economy. And so if you're Saudi and you're seeing all of the things we're talking about, you're going, man, we better get all this oil out of the ground ASAP, which means we need to get to 20 million barrels a day to cut our reserve life index to 27. And at the very least maximize that. And so all of that interplays with, I really have a hard time seeing oil above $50 a barrel for a very, very long time. And that's, again, good for natural gas producers in the United States.
When you're looking at Saudi, and Saudi has been very open about the fact that they want to participate in LNG. They're looking to increase their own consumption of natural gas within the region, but at the same time, they want to own about 20 MTPA. They've been sniffing around, hunting around for the right location to do that. And it's interesting because they clearly see something. There's something there, and I think the Sabic deal was, well, let's not dive too far. Let's stay within the vertical chain. Let's try to squeeze some value from Sabic and some of these others, because there's going to be a longevity in terms of there's always going to be chemical demand. There's going to be those poly demand. But I think you're starting to see that acceleration of, well, we need to get this going really quick. And you've seen them adjust. Like they increased the VAT tax to 15%. They've done things to cut the deficit to $9 billion. There's a lot of things that a lot of levers they're pulling. Which, when I look at that, to your point on oil price, they're preparing for a fight. And the fight's is essentially telling you, like, look, we're not preparing for the next 1 to 2 years. We're preparing for the next 10 to 15, because oil prices are going to be depressed, and we need to have some just coffers, something to really push in, to really get behind. And it's interesting because you're getting that move away, and China is becoming a big, ugly elephant in the room that is going to have to be addressed, and they're getting more and more aggressive.
Well, and the last piece I would say on that is, everything we've talked about during this conversation is the best interest of the country. And so the good of capitalism is that individuals thrive and they try and create. And so because of capitalism, the United States, as the model of that, has created some of the best, if not the greatest companies in the world. Mm-hmm. But the government can't coordinate the activities of a Google and a Netflix and an Amazon. They're their own nation states. Whereas in every other country with controlled economies, one government is making the interplay and trade-offs between what do I do with oil and investment and VAT and populace and healthcare. And so we're at a disadvantage with so much AI and data to a China, where the Chinese government can pick exactly what they want to do and put the entire force of the economy behind making that happen. Whereas in the US, everyone has such different interests that it plays out in companies like oil and gas. We have 700 or 400 oil and gas companies all competing for themselves, but no coordination. And as a result, we built a structure that ultimately implodes, whereas that doesn't occur in other countries. Where they're controlling the economy more. It's not an advocacy for that system. It's just one of the post-COVID world thoughts we're going to have to focus on.
Right. So before I get back to that point, when we're looking at, you made the comment about the $50, which I tend to agree with in terms of that pricing, but you can never say never. But when you're looking at rigs, we're at 318 rigs, 45 or so frac spreads. Do we go back to 800? Do we go back over 200? Or is this something where we're kind of here right now?
I've written this for a while, certainly since March 8th. I felt that the right number of rigs in a $50 to $60 world was 600. And so pre-COVID, I was sort of saying the U.S. is going to decline. You and I were on the same page. Mm-hmm. I think November 2019 was peak. And that as soon as that became clear and that companies didn't have the depth of inventory that they told the market, they were going to have to cover that up with financial discipline. So they were going to drop rigs anyway. Now, because of the ducks, because of the frac spread, because of the economics, I see rigs dropping below 200 and staying there. And, maybe they come up a bit for natural gas, but I don't see it. So I think that we have a permanent kind of 200 to 250 rigs and 50 to 100 frac spreads. And that's the entire U.S. market for the next 5, 6, 7, 8 years until, we truly, truly need more natural gas. And, right. And I feel like the guys in the Marcellus are so efficient at growing with as few rigs as they were running already. Do they really need the 800 rigs that we were putting into oil? Mm-hmm. I don't think so. And if barrels are cheaper from Saudi and cheaper from Iran and cheaper from Libya, does our country benefit more as a consumer of cheap barrels, or using debt to recompete for expensive barrels? And I don't see us doing that logically. And
so when you're thinking about that, I mean, that's you think that we see about 75% or 50% people that go bankrupt or consolidation under that scenario where you just get this massive pullback? And is that enough to offset the decline curve? Where do you kind of see the U.S. playing out in terms of long-term production?
So I think we're in the 7 to 8 million barrels a day sort of long term. I think that we consolidate from the 150 or so public companies and the 250 or so private equity companies. I think we consolidate ultimately to like 10. And so that's 10 big publics and 10 big privates like Hillcorp. Because, you know, these are expensive assets to run. There's a lot of liability with orphan wells and abandonment liabilities and corrosion and pipelines and green pressure. So I think that each state will have a consolidator that will be the big guy, and that you'll have an Exxon and a Chevron and a Shell and a BP and an EOG and a Pioneer and a couple others, and everyone else will be merged into that. The challenge is, how do you merge when balance sheets are so bad today and prices are so low? And so that will take 12 months to kind of play through. But again, that will be where priorities lay rather than on capital investment and growth. Right. And I think that's good for the industry to be profitable. We need less companies.
Yeah. It's just a matter of consolidation, you know, getting to that economies of scale and cleaning up the balance sheet, which is why I've always been, you know, we've built a society built on it's okay to fail. You're at a point where it's okay to fail. It's okay to go to bankruptcy. It's okay to just rejigger things. You know, you got overextended. Let's reset. And I think that you can see that happening again in bankruptcy. And there's a lot of reasons why it could work out, especially on this, you know, as you see the kind of that consolidation that you've talked about.
Well, and the core again is like Nike would not make shoes if they had to sell them for $7 a shoe. And so regardless, and with all of the supply and all of the geopolitics and all of the countries that are so embedded with oil revenue, they have to control the market. And the US, oil is a small segment of our economy and getting smaller by the day. And so to me, at the core, because you need $50 to $60 a barrel to even be profitable, all the choices that companies could make around growth or not growth or bankruptcy, not bankruptcy, the business at $35, every company's technically worth zero today. So everyone's just a zombie co waiting for higher prices. And that doesn't really encourage the innovation or the change that would usually happen in an industry that was disrupted.
And just getting back, you know, looking at industry getting disrupted, and you talked about China, and we've looked at these planned economies. When you look at that and you look at the failures in terms of the Great Leap Forward, a lot of these different failed views because they get so dead set on one movement and without allowing for human ingenuity. And just think of like the US, like we allow people to fail. We allow people to try something. And even if it's not the right way to do it, you know, that'll fail. And somebody will come back behind them and say, look, this is the right way to do it. I'm going to make money doing that. And now you have a situation where I would say that the US still has the advantage just because we still allow people to create, where you're not forced into one direction saying, this is what you need to do. You can do whatever you want. You can be creative and find your own niche and maybe find a better way to do it than what has been perceived or what has been directed. I mean, what's your view when you're thinking about this? Or is your view that AI takes away some of that guessing game and they can pivot fast enough that you won't get the same failure of like the Great Leap Forward?
Well, I certainly think AI changes the game. And that Russia as a planned economy in the 50s, 60s, 70s, 80s, I mean, you just didn't have the data to know how many cabbages you were going to need. And so like there were constantly food shortages and you just didn't have the ability to understand. Whereas in the US, I mean, look at the data that you and I look at every day that's publicly available in every single thing. People fly drones over like retail stores to figure out how they're using it. They download credit card data to know what consumers are buying. Like we have so much data. So certainly a properly planned economy can compete better in existing businesses. Where your point is 100% right is no one would have envisioned that an online bookseller would become the biggest company in the world. Yep. And now it's even hard. Like I want to reject Amazon and I want to not shop there and I want to shop at small businesses. But number one, I still can't. And number two, I can go on and order, like I ordered 5 golf shirts yesterday. So like the
At what
innovation,
discount? At what discount?
they were like $30. It was incredible. And so, I think the answer to the question is innovation, which will have to happen in a post-COVID world. We would never have done a Zoom call like this before. This was just not acceptable. News channels like CNBC would not be having reporters at home, right. with shoddy internet connections and weird things in the background. So innovation from the US, we will fill the gap and we'll continue to innovate, but it will be harder to compete in existing industries with centrally planned economies, right. I think.
And this kind of comes full circle when you think about Amazon and some of these others, as you called, essentially mini nation states. When we look back in during the robber barons, if you will, what did they do? But increase efficiency in transportation, in logistics, and supply chain. And what, like to what you just said, like what has Google, Amazon, all these guys done? They've created the same thing. Are we stifling a certain amount of innovation because we've let them get too big? Have we reached a point where we need to kind of break things down a little bit, force some things to break up to allow that innovation to come out, because then they can't go out, buy it, and then put it into some lockbox that you'll never see the light of day because it would be a risk to their business.
Well, one of the things that we have done very, very well is when something gets too big and powerful, we do tend to break it down. And you think about Microsoft with the antitrust, you think about what oil was. Exxon was the biggest and most powerful company in the world and acted like its own country. Right. And through the push of the environmental movement and everything that's happened, Exxon is no longer the force that it was. And soon Tesla will be bigger than Exxon. And I think that just the way our free market works, things are broken apart. And I would expect to see Amazon, Netflix, Facebook, all those things get broken up in the next 5 years to create jobs for small businesses, because it's the only way our economy works. Right.
Well, I appreciate the time. As always, it's always a fun conversation in terms of the different rabbit holes we go down. So, hopefully you'll be able to come back and be on with us again, and we could follow some of these other topics.
Well, I really appreciate having you on. I love the conversations, and I always love what you guys are doing. So keep it up. And Matt, I look forward to our next bet.